cold in here.
Yeah. You can hold her. Well, welcome in, everybody. You can see a lot of familiar names trickling into the virtual town hall. And we have our company mascot here today with us. No, not Shelly. That's Millie. Millie, our Cavachon. Say hi, Millie.
Some of you have met her, I think. A few of you have met her when she was a little puppy.
So we see a lot of familiar names, and then some names that are not so familiar. So welcome, everybody. And we'll get started here in just a few minutes. Hope everybody is staying safe and healthy and doing well. I'm drinking water right now, but it is after, it is 5:30, so maybe you're having a glass of wine or a beer as you listen to the virtual town hall.
Yeah. My water looks like something else, but it's just water.
You're thirsty.
So, I'm always thirsty. Yeah.
Hey, Angela, can you just confirm that you can hear us okay and see us okay?
Totally can hear and see you perfectly.
All right. So what's for dinner, Shelly?
Oh my gosh. I have to go home after this and make, I forget what it's called, but clams. It's got clam sausage. It's like a clam sausage white wine linguine. And we had to get, fun story. I bought about 45 middle neck, I think they're called clams. And the guy was very careful. He's like, make sure you keep the bags open because they were plastic bags so they don't die. And my husband decides on the one day of the year that he's going to organize the fridge that evening, and he basically tied up the bags of the clams and killed all of the clams for dinner. So yeah, so I had him go out yesterday and get a whole new set of clams. So just fun fact for all of you who don't know that about if you ever make a meal with that let your husbands know that they need air.
So you're saying I should stick to finance?
Yeah, don't organize the fridge anymore.
Yeah.
I appreciate it.
I'll just try to focus here.
So yes, that's
just
what
try
I'm
to
making for dinner.
Keep my focus and attention here at work.
Take two.
All right. Well, it is 5:30.
Yeah, I think we have.
And we have about 20 people on, and I think we were expected to have 30 to 35 people on. And again, for those of you that are clients, great to see your names. I see your names there. Great to see you. Thanks for joining us. And
Hi, mother-in-law, Bobby. Abe's mom is just joining us as well.
#1 fan is on.
Millie says hello.
And I see several people that are not clients as well. Welcome to you as well. And we just wanted to host this virtual town hall just to kind of give you an update on where we are as a company, when we plan to kind of reopen up here along with the rest of Virginia, and also just give you a state, kind of what we call State of the Union, and update on where the markets are right now and where we see the markets headed for the future. So I guess we can just begin.
Yeah, I think now is a good time to get
5:32. So
yeah.
Hey, we hope everybody's doing well, and it's great to see a lot of your names here. I know we've spoken to a lot of you here recently, and some of you, some of the names that I see, I know we haven't spoken recently, but.
And we're looking forward to seeing you guys back in the office, hopefully soon.
Yes. So as far as reopening the office goes, as probably most of you know or can assume, we've been, most of our team has been working from home since this started. And Shelly and I have been coming in every day, and one of our team members has been coming in. But the rest of the team is home. And we do plan to open up as long as the Virginia governor doesn't push back the timeline again. As long as Virginia is not pushed back again, we plan to open back up on June 1st. So on June 1st, and just
as far as in-office appointments go.
Yeah. So we've been conducting appointments as normal, but virtually via phone and video and webinar. And we actually have a lot of clients who we've never met face to face, who we just met through the phone and video and computer. Over the years, people would call into our radio program and show, and a lot of our clients kind of live at a distance, some on the Eastern Shore and just, an hour to 2 hours away, where it's just far enough that maybe they want to stay at home and talk to us over the phone and computer. So we actually have a lot of clients we've never met face to face, and of course, more so that we have that like to come into the office and see us person to person. So as long as things don't get pushed back again, we'll plan to open up on June 1st back in the office for in-office appointments, and then we'll always make it an option to have a virtual appointment as well if you're more comfortable with meeting virtually. And that's very easy for us, as we've done it for
we've always done that
over 3 years. So that's kind of where we are, just kind of opening up pretty much along with the rest of Virginia. Just wanted to give everybody a state of the union and an update on kind of where the markets are now and where we see them going for the future. As everybody knows, we're in the middle of a downturn, and as a lot of our clients know, even over the last few years, one of the big things we've been preaching is, hey, the market's on a tear, the market's doing fantastic, it's been on an 11-year bull run, the market can't continue to go up forever.
Yeah.
So, if you value protection, preservation, safety, peace of mind, sleeping well at night, just as much as you do growing your money, and man, the 20 to 30% returns are awesome. But what comes with 20 to 30% returns are losses and periods of time where it can be uncomfortable and volatility and uncertain times and unknown times. So, we kind of been preaching this for years is, hey, let's get ahead of this.
Because it's going to happen at some point.
Yeah, and actually these types of things are healthy and normal for the markets to act this way, because again, the market can't just continue to go straight up. It's got to go up and things will go well, and then there's going to be a setback, a correction, a downturn, recession, whatever you want to call it. And then typically what's normal is that the markets go up 3 or 4 years in a row, take a step back, 3 or 4 years in a row, take a step back. Well, we saw an 11-year bull run where pretty much from the bottom of 2009, when the market started to climb back up, to the beginning of 2020, over 11 years, we did not see that downturn and correction. And at every single time where we thought it was going to happen, when we had an election and a new president, and we had Brexit and a lot of different things between 2009 and the beginning of this year, it didn't happen, and the opposite happened, and the market continued to go up. So that was great. And we were telling people, hey, enjoy that phenomenal 11-year run, but let's get ahead of this next downturn, because at some point it's gonna happen. And
yeah, I think that the main thing is, that the certainty is that there's always going to be uncertainty with the market, and that's something that we've always just wanted people to keep top of mind. And interestingly, right before all this happened, we had a gentleman at our dinner workshop kind of question Abe when we're just talking about just the nature of the market, and he was so adamant, this was 2 weeks before all of this went south, that could never happen, that would never happen in the current state. And of course no one knew at that time, but it's just interesting that 2 weeks later everything went south. So it's just we don't know what's going to happen, but that's the point of what we do.
Right. So we've kind of been preaching over the years, since it's healthy and normal for the markets to go up and down, let's not take on more risk than we need to. Let's not be invested 80, 90, 100% in equities and stocks, because most of our clients can't handle that kind of roller coaster ride, up 30s, down 30s.
Or don't want to.
But yeah, and our clients value preservation of principal, protection, safety, and all those things with growth at the same time. So let's make sure that you're not taking more risks than you need to, and get in front of this and do the right things in advance. And our clients have. But for those who did not choose to work with us over the last couple of years, a lot of those people are re-engaging with us now and saying, hey, what can I do? You mentioned this a year or two ago, And, life's all about timing, and those people are re-engaging now, but, to be in their position is not nearly the same positions that our clients are in.
Yeah, it's interesting to see that comparison. I mean, we have 600 clients and we didn't receive any phone calls nor had to make any to our clients when this happened to reassure them or readjust or say it's okay, just stay the course. And we know many advisors that we're friends with. We have one in the neighborhood. Every single day he's been coming home with his head hanging low because of the situation he and his clients are in. And our clients are in a very different situation. And actually one of our clients who actually reached out to us, hi Allison, she's been a client with us for a number of years. She actually reached out to us and said something like, she was so happy that they'd made the decision to work with us years ago because of all this. This was back in March. And then we had a physician in Reston a couple weeks ago who was a newer client say that this was the best decision he's ever made. So to see that comparison of what's going on with our clients as opposed to the uncertainty that a lot of other pre-retirees and retirees are feeling, even those, and sometimes especially those that are working with other firms, it really feels like a blessing on both ends for us that we're able to provide that level of confidence right now.
So to our clients, I think our clients have been pretty content and confident in the plan that we've set up for you. And kudos to you for being prudent and proactive ahead of a big downturn, prudent and proactive when the market was up 30% last year. It's not the easiest thing to think about, taking some chips off the table, getting a little bit safer, reducing risk when the S&P was up 30%. But look what happened in March of this year. In 1 month, just 30 days, the S&P lost just as much. Just 1 month, the fastest downturn to a bear market in stock market history. Then what happens in April, I'll go ahead and continue with the current state. What happens in April is that just last month is that we had one of the best months in stock market history. So I think there are a lot of people out there that think maybe we've already hit the lows. But if this bear market is like most other bear markets, what happens in most bear markets, 60% of the time or more, is that we have a big drop, which takes everybody off guard, which happened in March. And then we have what's called a head fake rebound, where the market goes up and we have one of the worst months in market history in March, one of the best months in market history the month after. And we're like, how in the world did that happen? At the same time, 20-something million people became unemployed. And now, as of today, I think it's 36 million people are unemployed. The market had one of its best months in history after not having much good news. There wasn't really a lot of good news in March, much more bad news than good news. And then the market does the opposite. It just continues to go up and had a great rebound month. That is very normal and typical in a bear market, if you didn't know that. And what's also very normal and typical in a bear market is for then, after that down and up, for there to be another big drop that retests the lows that we hit in March. So I really do believe that's going to happen. And I believe from everything that we've been reading and hearing and people that we've been talking to and experts that we follow, we believe that will probably happen sometime in between August and October of this year, because it's going to take time for all the states to open back up and for all the phases for us to go through all the phases. And once we go through that and kind of get through the summer, then I think we're going to see what the true damage is economically and financially. Like how many companies actually don't even survive this? How many more people are unemployed? And then the companies that do survive, what do they look like now? Because some companies are going to be changed forever. And there are going to be industries and companies that need bailout money and government intervention just to survive. And I think a lot of that news is going to come out late summer. And that's when we believe, I could be totally wrong and nobody knows the future, but this is looking like it's going to shape up to be a situation that's worse than 2008. And we all know how bad that was. So that's why we wanted to do this town hall today, is not to scare anybody. There's no need to be scared of anything. We're just trying to give you all the information that we know and that we're hearing and seeing from. I was just speaking to a guy today who has been on the investment side for 30 years, and he's worked for Goldman Sachs, Merrill Lynch, Edelman, Fisher, and one other big firm, big time firms, 30 years of investment experience. And he thinks that we are going to see a significant drop later this year, just like I think we will. And he thinks it's going to be a 6-year recovery. One of the guys that I follow who is really, really sharp, his name is Scott Minard, and he's the chief investment officer for Guggenheim Investments. And they manage portfolios for all these big insurance companies, and they manage institutional wealth. And he believes that the S&P will drop down below 2,000 this year, which is another 30% drop, meaning for over a 40% drop this year. And they believe we're looking at a 4-year recovery, so similar to that of a 2008. Again, some of this is speculation, but I just want to try to prepare every single person we talk to for what seems to be the inevitable later this year, and then what that next 3 to 6 years could potentially look like. So for our clients, I mean, our clients have been pretty content and happy with what we set up, and we set up the plans and strategies that we've set up for you so that in bad times, just as well as good times, you can sleep at night and not worry. You can know that a good chunk of your portfolio and your hard-earned nest egg is protected from these really volatile downturns, and that some or a lot of your retirement income is protected from these volatile downturns. To our non-clients and those that are considering working with us, I would just say to you, wouldn't you want to be in the same position that our clients are in? Not really worry too much about what's going on. Everybody worries to an extent, but
the market's like the icing on the cake rather than what your retirement is relying on.
Right.
And I think that makes a difference for how people are feeling.
Right. So, to our non-clients, life is all about timing, and perhaps you met with us in the past, perhaps you're currently meeting with us now. And I can tell you there's probably no better time to get a plan in place that matches your age, your risk tolerance, your goals, because we just had a big rebound month in April. And I think what's to come is going to be a lot worse. It's going to get a lot worse. So, in March when we were having these conversations with people, when the S&P is down 30%, it's like, well, shoot, I'm down 30%. I don't really want to make a move if I'm down that much. Now, if you look at your whole portfolio, you're probably down less than 10 and probably only around 5% or so. So the way we see it is, if you're going to move and reposition any monies and reduce risk, would you rather want a 5 or 6% loss or the potential for 20, 30, 40 or more % loss? The way we see it is that for anybody that's looking to reduce risk and make some changes right now, you have 3 options. Number 1, the first option is to totally get out and say, I'm going to cash. And we've talked to quite a few people, even clients, who, other than the strategies they have set up with us, have gone entirely to cash. We talked to one gentleman who was a client of ours, and in last fall, we didn't know it, but last fall, around October of 2019, he went entirely to cash. And here's why he went to cash. This is when the S&P was continuing to go up and hit 30% last year. He and his wife went to cash because he followed one of Warren Buffett's quotes. And that quote that Warren Buffett said was, why risk what you have for something you don't need? Why risk what you have for something you don't need? So he realized in October of 2019 that he and his wife had hit their retirement goals, and that the money that they had saved was enough. So then why risk it? At that point, with them retiring, I think this year or next year, why risk this money that they've worked so hard for when they've saved and achieved enough? So they went entirely to cash. And if he were to, if they were to have told, people about that, they probably would have, many people would have probably told them they're crazy for doing that. Like, what do you see that we don't see? So the first option I see is to entirely get out of the market and to go to cash. And perhaps that's a solution for some people, and I would say for more people than not, it's not the right option. Number 2, what we hear from our competitors is ride it out. Okay. Well, what's really interesting about what we hear from our competition and what clients are getting from our competition is that when the market's up and the market's up 30%, most investment advisors will tell you not to sell because you'd be crazy to sell. Your portfolio is up 30%. Shelly, why are you selling your investments? You're up 30%. Like, what are you thinking? Don't sell. And then the same advisors are going to tell you the same exact thing right now. Shelley, are you crazy? Why would you
It's so
sell?
low,
Your
yeah.
your portfolio's down 10%, 20%, 30%. You know you should never sell when the market's down. So if the market's up 30 and down 30 or down whatever, when is the right time to
Same
sell?
answer,
They're never
yeah.
going to tell you to sell because they don't want to lose your money that you have with
Yeah,
them.
and in fact, we've had some people recently that did business with it, they're working with another firm, and when they've been very interested in putting protection in their portfolio, and they were really on the fence, and they ended up working with this really large firm. And then they went and did additional business when they basically told their advisor they want protection, they want safety. Well, of course they're going to tell you, oh, we can do that for you. I mean, they're never going to say, oh, no, we don't do any of this. No, just take it elsewhere. So what they offered this person was not great. And I spoke to them, and then this person spoke briefly to Abe, but the solution was misleading. It wasn't truly a safe strategy. They kind of gave her a half truth. And so that's something to also be wary of if you're someone we've spoken with, is if you're working with another firm that's really heavily growth and accumulation focused. If you say, things are shaky, I want safety, I want more protection, they're going to find some sort of piecemeal way to give it to you. But oftentimes it doesn't even compare to a lot of the solutions we offer. And quite frankly, those advisors' expertise in that area don't hold a candle to Abe. So that's always been our philosophy. So if that's something that you're looking to add into your portfolio, especially considering the current times, just be wary of those firms telling you they can take care of that for you. It's not the same.
What we find is that 97% of retirement planning advice given is on accumulation. So when you hear of all these big name firms, some of them I just mentioned a few minutes ago, they do a great job of helping you invest and save and accumulate.
Yeah.
But a retirement plan is just not accumulation. I mean, if all you have is an accumulation plan, that is not a retirement plan, because the second phase of retirement planning is income. There are only two phases of retirement planning: accumulation and income. And most of our clients are 60 to 70, 55 to 75, in that range, and they don't have an accumulation problem. They're coming to us with $500,000 to $3 million, usually in that range. Oftentimes they don't have a savings problem, they don't have an accumulation problem. All the problems lie in the back end phase of retirement, with the potential for higher taxes, the potential for a major market downturn, inflation, healthcare, sequence risk. And that's where we really specialize, is in that second phase of retirement planning, the income phase and distribution phase, where we really now want to protect the last 20, 30, 40 years of your work and make sure you keep the most amount of your money in your pockets, the less to Uncle Sam and the less to, major market losses. So the first option would be to get out of the market entirely. That may or may not be the best option for you. If you have 1 or 2 years left before you are done and you are fully retiring, then for me personally, to be in cash and to be into something really, really safe, where you're getting 1 or 2% or less than that, to avoid a loss with 1 to 2 years left before retirement, might be a decent option. Number 2, write it out. And I think it's okay to write it out on a chunk of your portfolio, and that chunk in which you are comfortable with taking risk. For an example, if you have $1 million saved and you tell us you're a 5 on the risk scale. So a 5 would be, on that risk scale, between 1 to 10, a 1 would be someone who never wants to lose a penny in the market, and a 10 would be somebody who can handle all the ups and all the downs. Well, I can tell you what, our clients are never a 10, otherwise they'll never work with us.
Yeah.
And we'll never work with them because our philosophies will never jive, and we want to appreciate each other's opinions and so forth. So most of our clients, if I had to guess, are in between a 2, which would be very conservative, to maybe a 7. And if we ever have a client that's an 8 or a 9, that's a very risky, aggressive investor. And we don't see a lot of those really with our client base. So let's say you're a 5 and you have $1 million. That would tell us that 50% of your money should be in the market and taking smart risk. 50% of your money should be out of the market, where you have total downside protection. You can never lose a penny on that 50% of that money. And you're okay with a reasonable return because you don't want all the ups and downs of the market. So 50 in, 50 out if you're a 5 on the scale. If you're a 3 on the scale, well, that means you want 70% of your money protected and you're okay with 30% of your money kind of going up and down and riding the market out. The third option would be to be smart and to reduce risk and match your risk up and your portfolio up with your risk tolerance. So a good example, if you're a client of ours and we helped you out 2 to 3 years ago in 2016, 2017, 2018, well, since then, if we made no more changes to your plan, the market shot up, right? And what you had when we started working with you should be a good bit more over those couple of years, and your allocations could have become out of whack. Like after you started working with us, if you were a 60-40 and the market shot up, now you might be an 80-20 or 70-30. We need to bring that 80 or 70 down to match your risk tolerance. So if you were then a 7 on the scale and you're now a 5, we need to reduce risk in your portfolio by 20%. I hope that makes sense. So that's typically what we recommend for most people is be smart, reduce risk, don't take more risk on than you need to, and match up the risk, your risk tolerance with your goals and objectives and where you are right now today in life. Because we can tell you that most people's risk tolerances today are not what they were even last year and a couple years ago. So we've kind of given you an update on where we think the market's headed. I don't think it looks too pretty heading into the later part of this year. And I do think we're in for a pretty significant downturn. And I do think it'll take, years, much like 2008, to kind of get back up to where we were earlier this year. What I would encourage you guys to do is control what you can control. So we can't control how high taxes go up. We can't control when the market goes up and down, but we can control where to invest and how to invest and where to get these monies right now. So I would encourage you to control what you can control. And even beyond your investments, I would encourage you to look at other areas in your plan that you can maximize and leverage and improve. For example, if you haven't done anything about long-term care insurance, and let's say perhaps you can't self-insure and you don't have enough money saved to self-insure, then we need to look at getting something in place, whether it's a long-term care policy, a life insurance policy with long-term care benefits, an annuity with long-term care benefits. We got to do something. We can't just ignore it. Estate planning. If you haven't set up wills and trusts, the estate planning process and part of your retirement planning portfolio is really important. And perhaps now with more time at home, you can spend some of that time getting your estate plan affairs in order. I would also encourage you to look at your portfolio right now and look for low-hanging fruit. What I mean by low-hanging fruit is any monies you have in your savings plan and your investment plan that's not earning much money. So bonds would be a great place to look at. What percentage of your money do you have in bonds? Because the outlook for bond returns the next decade is really low. The outlook is in between 1% to 3%. So if you've got 10, 20, 30, 40% of your money in the bond asset class, don't expect to earn much more than 3%. I mean, when the chief investment officer of Guggenheim is telling us as a company, Guggenheim the company, that they don't plan to earn more than 3% on their bond portfolio, then we as individuals shouldn't plan to earn more than that either on that asset class. So look at what you have in bonds. If you have a lot of cash right now hanging out in the bank and you're looking for a safer home to grow it, keeping it safe, enjoy some tax advantages, that'd be a good place to look. CDs that are coming due, money market money. If you own a TSP and you have money in the G fund, the G fund is only paying 0.75% for May of 2020. Yes, it's backed by government treasuries, but it's paying less than 1% in the G fund and the TSP. So I would encourage you to look at low-hanging fruit in the portfolio and see what you can do to leverage and pick up the upside. And we have strategies and planning options we can give you to help you with some of those assets in your plan that you think you can improve on. And finally, what I'll end with, and then we'll open it up for questions and answers, is to our clients, if we haven't spoken to you in a while, if we haven't spoken to you since 2019 or prior, I would encourage just having a 15-minute conversation with me and our team. Let's just get up to date. Let's catch up. because obviously a lot has happened and changed since last year and before to where we are today. So for our clients we haven't met with, let's just have another review and just catch up and make sure we're on the same page. For our non-clients, if you haven't met with us ever, I would encourage you to take advantage of what we call a where do I stand plan. Where do you stand today in regards to your retirement? Whether you're working with another advisor, whether you're a successful do-it-yourself investor, just get a second opinion. We're not going to charge you a penny. We don't make a penny unless you ended up working with us. So all of our advice, all of the planning we provide and the tools we provide is totally complimentary, and we're not going to push you to do a thing. We're just going to lay out all your options, give them to you, and then you can choose what you want to do with it.
But I can tell you about our clients and what I think speaks highly to not only Abe being a genuine person, but just his recommendations being really great, is that basically we, of our 600 clients, once people become a client, they don't leave. They don't go back to their other firm. And most people do come to us working with another firm. And so, and also many times, and we actually just had a couple clients during this time do additional business. Our clients come back, year after year and do additional business as their situations change. So we do put our clients in a very good position, one in which they're comfortable for years and they don't feel like they've made a wrong decision or want to back out or go a different direction. So I think that's encouraging for us, and that's something we wish that we could share a little bit more often with people.
And also to our non-clients who have met with us in the past, but maybe have not chosen to work with us just yet, I would encourage you to revisit the plan we put together for you. And perhaps it needs some updating. Perhaps we met years ago. And life's all about timing. Perhaps you were 5 years away from retirement then, and this year you're retiring, or next year. So life's all about timing. I would encourage you just to re-engage with us and let us give you our current assessment of your plan, and perhaps now would be a better time for you. So I would encourage you to do that. And then for our clients, I believe you strongly understand how we have helped you and how we can help you weather the ups and downs of the markets for your retirement plan and portfolio. And we would love the opportunity to meet people just like you and to help them, to give them this information and allow them the opportunity to be in the same positions you're in. So we'll all win by that, that way. If, you'll feel great about referring us to somebody that you're close with, whether it's a family member or a friend, a church member, a school colleague.
Neighbors are really close right now, so.
Right. You'll win for doing a good thing and introducing them to us. We'll win because we'll have a new client, and they'll win because they'll be in a better position too. So we'll all win. And I'm going to go ahead and end with that. We're at about 25 minutes, and we're going to open it up for questions and answers. So you can go ahead and ask those questions in the digital chat, and then Angela, one of our team members, is going to relay those questions to me.
And for now, Millie's just going to stick her head in the sand and just.
She's passed out.
This is a very boring topic for her.
She's passed out.
Right to sleep.
Yeah, she is done. Down for the count. So hopefully that wasn't this boring.
No.
All right. So we have a question here. Let's see what the question is. Last time on one of our webinars, you mentioned that the qualified charitable deduction, QCD, can be used to avoid taxes from an RMD. Can I donate a QCD to my own charitable foundation, donor advised fund, to avoid the taxes? I believe we've gotten that question before, and I am not sure. And I don't like giving people an answer that I'm not 100% sure about. So that's a great question. I have it right here. And to that person who asked that question, we will find out for you by tomorrow. We have an advanced planning department that has attorneys and CPAs and pretty high credentialed people on the team. So
that's a good question though.
We'll find out by tomorrow and get back to you. The question was basically, when you're in the RMD phase and you're 70 and a half, 72 and older and taking out RMDs, you can actually donate the entire RMD to the charity of your choice through what's called a QCD, a qualified charitable deduction. And instead of you receiving the money, you don't receive the money. You don't pay any taxes on it. And then the money that's donated to the 501c3, your church, school, whoever, they don't pay taxes on it either. But if it's your own nonprofit, I am not sure.
No, we did have a client donate to, Abe and I have a nonprofit to help seniors called Love of Gray, and we did have a client donate to that through her RMDs over the holidays, but again, it was not her own foundation or charity.
Right, and in that case, with her donating that QCD to the Love of Gray Foundation, she's not taxed a penny on that RMD, and the nonprofit isn't either. So that's a great way, if you are headed into the RMD phase or already there, for you to continue to give back in retirement and not be taxed on those RMDs and donate that money, some or all of your RMD, to the charity of your choice. Great question. We'll get that question answered by tomorrow and get back to you.
I think we have another one.
We have another question here. If I have leftover funds from my RMD, what is the best way to invest that fund? There is no stretch IRA now. What is the best course of action? Correct, yeah. So basically the question is from one of our clients. If I have leftover monies remaining from my RMD that I can now invest, what is the best way to invest that money? So I would just say it really depends. It really depends on a lot of things. Number one, your risk tolerance and the type and amount of risk that you can handle. And that would depend on where the money goes, number one. Number two, what do you want to achieve? Is this money that, it doesn't sound like this is money that you're going to need for income in retirement, because you got leftover money from the RMD and you can actually invest it. So it doesn't sound like you'll need it for income, which means to me, you can invest it more for the long term, maybe take on more risk there. Perhaps you don't have any long-term care. Perhaps you want to get that in place. Perhaps it's really important for you to pass on money to your spouse and kids and grandkids. Well, there are strategies there that you can set up. Life insurance comes to mind, where you can take that RMD and basically leverage it. That's what we call the IRA rescue, actually. The IRA rescue, taking excess RMD monies that you don't need for income, putting them into life insurance policies to create a leveraged death benefit, that all passes tax-free to your heirs. So that's a great way to leave money to your spouse, kids, grandkids, great way to leave a legacy behind for the people that you love. Just one idea that came to mind.
Nellie's snoring, by the way, so.
Oh, goodness.
I think the questions are great, though. So you answered the second one as well? The second
And
part.
there is no stretch IRA now. What is the best course of action? I think the questions were basically intertwined there.
Okay, so we have another one.
The next question is from a client.
Yes.
If we've already secured 40 to 50% of our assets in secure strategies with you, should we be putting more of our nest egg in secured products and strategies? Yes and no. So to that client who asked that question, let's say the exact amount of monies that you have secured and protected is 50% of your portfolio. If you are comfortable with being a 5 on that risk scale and 50% of your money is safe and protected from downturns with reasonable returns in the future, then no, more money should not be on that side, but it sounds like you'd be comfortable with a 50-50 split. If, since working with you over time, your risk tolerance has come down, and maybe you were a 5, 6, 7 when we started, and now you and your wife are now a 3 or a 4, there could be room for a small reposition, maybe a 10% reposition, but you never want all your eggs in one basket. And so for most of our clients have enough monies where they have Social Security, 2 checks coming in, they might have a pension or 2, they've got $1 million, $1.5 million, couple million, whatever it is, saved, and most of our clients can handle some amount of risk, whatever that amount might be. So I hope that answers your question. If you'd like, to the client that asked that question, we can just get on a brief phone call you kind of look at the exact split that you are right now between the market and out of the market, kind of determine if we need to make another move right now or just stay put. Another great question. You want to read that one off? Can you see it?
Oh yeah. How do you determine when a person can self-insure long-term care?
How do you determine when a person can self-insure for long-term care?
Those are good questions. They're all different.
I would say that the amount typically has to be over $1 million, because if you've got $1 million or under, I really think you're going to need the majority of that money to generate income for you in retirement. In some situations, no, but typically where I see people can self-insure for long-term care are when they have usually about $1.5 million or up. So if you have more than $1.5 million saved, it's probably a good chance you'll be able to self-insure. If you have less, maybe, maybe not, depending on how much you're spending every month. If your budget and if your net income need in retirement is pretty low, you're not big spenders, then perhaps you can still self-insure. But I'd be happy just to have a brief phone call with you, to the client that asked that question, and just talk through your situation for 5 or 10 minutes.
Can they set that up through here directly? Right on this.
So in the digital chat, if you just want to, so one of our team members can just put in a live calendar link right now to make it easy for you.
So for those several clients and non-clients that ask the questions that you just referred to, you can directly just chat, and Angela can send you a Calendly link, and you can just pick a time when you're available right now. So that might make it easy.
We can put a live calendar link right in the chat. Yeah. You can just click on that and
so
set up a time. Set up a time. Or just shoot us an email or give the office a call.
I think, yeah. I think actually the Calendly link's just for first appointments.
Sorry, we both, as the owners of the company, we both misspoke. That calendar link
it's for first appointments.
It's only for first appointments, which would really be someone who has never met with us before.
But regardless, I think for clients, Angela can help you out there, I think.
Yeah. Anybody that wants to have a conversation, just let one of our team members know in the chat. We're happy to get set that up with you ASAP.
See if we have any.
That looks like it might be all of the questions there. No, we have another question.
Another one. Okay.
Oh, good question. What will the effect of the economy have on the housing market? I don't know. I don't know, but I have heard already from our clients, some of our clients that have rental properties, is that they're already seeing some of their renters lose their jobs, and they're concerned about having their rental properties rented out steadily through this next few years, because I think it's going to be dicey and unknown. Not every time the market goes down does the housing market go down at the same time. They're not connected that way all the time. Now in 2008, I think the main reason, one of the main reasons why we had that crisis was because of mortgage-backed securities and people working at McDonald's buying $1 million house. And that didn't add up, and that's why we had the housing mess that we had. So I don't know that we're going to see that happen here, but I think you can see that. I think there's potential to have some problems. I think housing values could go down, and I think if you have rental properties, this could be one of those periods of time where that income isn't as steady as it usually is when the economy is just humming along really well. So to answer that question from the client, I'm not exactly sure what the effect of the economy will have on the housing market. I can tell you that right now, with interest rates being so low, a lot of our clients don't have mortgages on their homes, but if you do, and you're paying more than 3.5% on a 30-year mortgage or 15-year mortgage, now might be a very, very good time to look at a refinance. We're going to look at one ourselves, and we're at 3.75, and I think there's potential for us to get that rate down. So keep an eye on interest rates, but I'm not exactly sure what will happen with the housing market.
See if we have any.
Sorry, I don't know if that answer helped you out there too much. Just
I think we have another.
I'm not super up to speed on the housing market.
So do we have any other questions? No question's a bad question. These are all pretty good so far.
Any other
Everyone's
any other
okay.
questions? Millie? Oh, she opened her eye.
Yeah, I think
I don't think
that,
she has any.
um,
No other questions so far. You know what? So I hopefully this virtual town hall was helpful, and at the very least you're able to get our insight, and instead of having a ton of different individual conversations, we thought it'd be great to have a town hall where we can have questions answered and just give you our State of the Union. So we hope it was helpful and valuable, and
at the very least, you could look at a cute puppy. I mean, it can't be
at the
bad.
very least, at the very least. And I think people get sick and tired of seeing me, so it's nice to see some other people here.
Oh, thanks.
Like my wife Shelley.
Yeah, hi.
We're going to go ahead and wrap up. Hope you guys continue to stay safe and healthy, and we'll be in touch. And for our clients, if there's anything you need, please call us anytime, and we'd be happy to give you our input on anything you're seeking input for. And for our non-clients, if you're currently meeting with us, we look forward to meeting with you again soon. And for our non-clients who haven't met with us ever before, we would encourage you to take a complimentary Where Do I Stand plan meeting, a complimentary second opinion on your retirement plan. With that.
Well, thank you guys. We appreciate you attending.
Oh, you know what? I forgot one other thing.
Last thing.
And we
PS.
wanted to show you, we won this because of our clients and because of you guys. For the second year in a row, we won Loudoun County's #1 financial advisor firm through the Loudoun Times Mirror. And over 200,000 people this year voted. So, Shelley can only vote so many times for us. My mom can only vote so many times for us. But 200,000 people voted across all the different categories. And to you, our clients, thank you so much for taking the time.
Really appreciate that.
I know it was 2 rounds, and I know it can be a little annoying to get on there and vote. So thank you so much. This is for you, because without you, we are nothing. So thank you very much.
Thank you.
Okay, guys, we're going to end the virtual town hall. You guys take care.
Oh, and thanks for the dog compliments.
Somebody said nice pooch.
Nice.
Okay, guys, take care. Now we got to figure out
The
how to
fun
end
part is figuring out how to end this.
it. Yeah.
This one. If you.
Angela, maybe you can just end it on your end.